Welcome to another Nebraska Farmcast from the Center for Agricultural Profitability at the University of Nebraska-Lincoln. I'm Ryan Evans, and today I'll be joined by Glennis McClure, an Extension Educator and Farm and Ranch Management Analyst with the Center for Ag Profitability here at UNL. She's got a new article up on our website at cap.unl.edu that discusses why traditional tax documents might not tell the full story of a farm's financial health and how accrual adjustments in accounting can offer a clearer picture. Glennis, thanks for joining me.
Well, thanks for having me again, Ryan.
Yeah, so in your new article that we're going to cover, could you just start by explaining from that why it's important for farm and ranch operations to go beyond just the net income or loss that's shown on the Schedule F when they're looking at their financial health?
Well, yes, I think it's really important. Farm or ranch business should know what their actual or true net income is, or in other words, their profitability. And this takes figuring beyond what the Schedule F tax form shows us. So net farm income generated from the business should be adequate to cover family living, cover annual taxes that are due, and the remainder is what's available to reinvest back into your operation. Most farm and ranch businesses are cash basis accounting folks, okay, rather than accrual basis. And that's generally for tax purposes. So we need to take the time and make accrual adjustments to get to our actual, or what I call true profit amount. And so there is a relationship between the true farm income or profitability that is on the bottom line figure off of a profit and loss or income statement to the change in net worth from beginning of the year to the next. And this is what I explained in the article. And it relates back to what is being invested into the operation from net farm income. So again, if we take net farm income and we have to pay income taxes if we have a positive, we generally want to have some kind of living from our business. There is off-farm income that can help, though, of course, in many cases. But then the residual is what you have to reinvest, or in other words, like pay down debt and that type of thing. So most businesses want to grow their net worth over time. And this is definitely an important figure to look at. Really, what is their true profitability?
Yeah, and you do discuss in your article quite a bit about preparing an income statement with accrual adjustments. So can you explain what those accrual adjustments are and then how they differ from the figures that might typically be reported on income tax statements?
Okay. So, an accrual adjustments, with that, we're trying to get a clear picture again of the value of production for the accounting year and the actual expenses that relate to that production. So it could be, cattle production, crop production, any of that. So because there's so much that we have to put into those crops, so much that we have to put into those livestock. And so we're growing and we're producing through that year. So at the end of the year, we may not have sold all that year's production. So oftentimes we do have inventory. So at the end of the year, I still may have those calves that were born and raised, and I still haven't sold them as of, let's say, January 1. Same way with my crops. Oftentimes I carry those over, watching the market, getting ready to sell when that market opportunity is there. So in our records for the year, we may not have sold, or we end up carrying over that crop or that livestock from the prior year as well. So I can look at the end of the year and say, yeah, I still have some of this year's production left. Even a year ago, I had something from the prior year. So what we're trying to do with these accrual adjustments is to really get a real picture of what happened for a particular year. So, and again, prepaid expenses come into play. Like our seed or our feed and those kinds of things. So those are the kinds of adjustments that an income statement worksheet, really is for. And I do include an example, kind of a thorough example in the article in Figure 1, where I go through those different adjustments. So cash basis taxpayer will show a Schedule F net farm income or net farm profit or loss that is figured by adding all revenue received for the year minus expenses that they paid for the year. And this revenue most likely will have sales from carryover inventory from the prior year, and oftentimes might have cash expenses that really pertain to the next year. So it's not exactly for that tax year. And then there's a tax depreciation figure that also needs adjusting. That's part of that. It's part of that whole income statement worksheet. So an inventory adjustment example that I use in that is that, let's say we had $80,000 worth of crops and feed on hand at the beginning of the year. So this is likely carryover from the prior year. And at the end of the year, let's say we have $105,000 of crops and feed on hand. And so that inventory adjustment is a positive $25,000. So this figure gets added as an accrual adjustment. If this inventory value at the end was lower, it'd be a negative adjustment. So what is being reflected in this positive $25,000 adjustment is that the net cash income shown on the Schedule F does not include at least $25,000 worth of production value from the current year, so it needs added back in. And there's a list of adjustments, again, in this worksheet, not just, again, that crop inventory or livestock inventory. And where do these adjustments come from? Well, we do a beginning year balance sheet and an end of year balance sheet to basically see how those changes are and where those come from.
And you mentioned depreciation, a significant factor in farm accounting, obviously. So how does the approach to depreciation differ under tax rules and then management perspectives, especially when it comes to the IRS and Section 179 rules?
Yeah, definitely. It's something that we really need to consider and take into account because depreciation can be a significant factor. So as I said, generally that Schedule F, we're talking about our cash revenue and our cash expenses, but depreciation is different, of course. And in many cases, the depreciation expense figure used on the Schedule F form is different from actual use depreciation due to like IRS rules, the 179 rule, and accelerated depreciation rule that allows qualified business owners a deduction up to the total amount of the capital purchase, providing an instant expense deduction that helps us in lowering our taxes in a given year. So keep in mind, though, that Section 179 and accelerated tax depreciation rules can change from time to time based on current law, and you always have to check with your tax accountant on how they're figuring that or whether your business is eligible. But when figuring actual usage or management depreciation, the calculation is the original purchase price of the asset minus an estimated salvage value that you're going to figure when you're done using it, then figuring the value of that asset in proportion to its useful life each year until the salvage value is reached.
And you provide another great example in the article. I encourage listeners to do check out the article because Glennis does have these great examples. You can find that link in the podcast notes here and on our website at cap.unl.edu. But you provide this practical example that involves a $50,000 wagon in your article. So could you just walk us through how that example illustrates the impact of actual use depreciation versus tax depreciation on a financial statement?
So yeah, the $50,000 wagon, let's say for use on my farm or on my ranch, I figure a useful life of 10 years. Okay, I figure I'm going to have it around that long. And then I'm going to figure that when I'm ready to sell it or trade it, it's going to be worth about $20,000. So that would be $30,000, the $50,000 minus the $20,000, divided by the 10 years of use. That would be $3,000 a year of depreciation. So on a cost basis balance sheet, when the new wagon is shown, like somewhere in the beginning of the year when I bought it, it was worth $50,000, a $50,000 asset. And then at the end of the year, just looking at actual use depreciation, it would be worth $47,000. So, and then of course the next year after that, it'd be worth $44,000. So each year we're taking off $3,000 of value on that if we're just considering sort of what we'd say is actual use. So with accelerated depreciation, such as the 179 expense, if I wanted the tax deduction, we could have written the whole wagon off in 1 year, but we know that wagon still has useful life. So that's what we're getting at there is look at really what on a cost basis balance sheet, Again, actual use balance sheet, beginning and end, that change isn't where, all of a sudden this thing's not worth anything. It's still worth a lot. And so that's where we get back to doing those depreciation adjustments so we can see really what true net income is.
Great. And then when it comes to inventory adjustments, can you discuss challenges that farms face with those inventory adjustments, that is, and then how farms can effectively manage changes throughout the year?
Yes. So, we talked a little bit about already, kind of what's involved in those inventory changes. But inventory changes from year to year are really inevitable for most operations. And sales and management decisions are made oftentimes based on what the markets are offering. So crops and livestock might be sold earlier one year and in other years kept in inventory and sold later. And that's okay. And it's a good management practice to always do some income tax planning before the accounting year is up. Again, based on the market and our price of our inputs, it can be a great savings to prepay sometimes or hold off selling some things. So you really need to take a look at where you are with your tax situation. It's often done, sometimes soon after harvest in the fall, if you're January 1 to January 1 taxpayer. Generally, the best rule of thumb regarding income tax management is that you don't want wild swings in net income from year to year. So paying taxes in a lower bracket and then bumping up to a higher bracket might cost you more in taxes. Spreading taxable income out and utilizing lower brackets when possible will help us keep our income taxes in check. The important thing is that a cost basis balance sheet should be prepared each year again. It's from the balance sheet that the inventory adjustments come from, and that can be used in calculating our actual net income or profitability.
And then just to wrap up, are there some common pitfalls that farms might encounter in maintaining financial stability and growing their net worth and maintaining that growth? What are those pitfalls? And then are there strategies you might recommend to avoid them?
Well, businesses really do want to be profitable and see a positive net worth growth over time. That's usually our goal as a business owner, whether it's, a business in town or it's a farm or ranch. So again, it's trying to reduce wide swings in taxable income from year to year, and that can really pay off. We get that, and that's kind of why you see sometimes our Schedule F profitability not, exactly close to what it really truly is. In the example that I share in the article, we've got Schedule F net farm profits at $6,500. So $6,500 was the net showing on the Schedule F. And when we went through it to do those adjustments, all of a sudden the net farm income is up to $60,000. So that's huge. That's a $50-some thousand swing. And that's good because the true profitability is what you want, okay? So true or actual net farm income or profitability, again, not the bottom line figure from the Schedule F, must be positive enough to cover our personal withdrawals or family living expenses unless there's off-farm income, enough to pay income taxes owed based on the farm's income generation for the year, and then to reinvest or pay down debt. So if we see positive net worth change or growth from the beginning cost basis balance sheet to the end of the year balance sheet, then we know we've adequately covered those three factors and the operation was profitable.
Great. Well, that's Glennis McClure, Extension Educator and Farm and Ranch Management Analyst with the Center for Agricultural Profitability. Again, you can read her new article on what we've been discussing here on this episode of Nebraska Farmcast. That's on our website for the Center for Ag Profitability at cap.unl.edu. And if you're listening on a podcast platform out there, you can also find it in the notes for the podcast. Glennis, thanks for the great info.
Hey, thanks again.
Nebraska Farmcast is a production of the Center for Agricultural Profitability at the University of Nebraska-Lincoln. For the latest research-based information and education resources to manage your farm or ranch operation, visit our website at cap.unl.edu. That's cap.unl.edu.